Welcome to our deep dive into the kind of curious world of crude oil. Today we're tackling a question that might surprise you. Does the Santa rally, that festive stock market surge we all hear about, actually apply to oil? I mean, it's a global commodity, not exactly a stocking stuffer, right?
That's a great question. It is, and it leads to some fascinating insights. We typically associate the Santa rally with stocks rising in that cozy period between Christmas and New Year's. But oil, well, oil dances to the beat of its own drum, doesn't it?
Exactly. Geopolitics, supply chains, global demand. It all feels a bit more complicated than just holiday cheer. Right?
You're absolutely right. Oil's a different beast altogether. So to figure out if there's any truth to this Santa rally in oil, we've pulled data from a really interesting period, 2021 to 2023. Now, those years were a roller coaster for oil markets. Remember, pandemic recovery, the Russia-Ukraine conflict throwing a wrench into energy markets.
Oh, I definitely remember. It felt like every time you turned on the news, there was a new headline about oil prices going haywire. So how does a seasonal pattern even stand a chance amidst all that chaos? That's what I'm curious about.
It's a puzzle, isn't it? Almost like we're trying to find a subtle signal amidst a lot of noise. Let's start with 2021. Oil was climbing back from those pandemic lows, but then Omicron hit the scene. And there was this sudden wave of uncertainty.
Yeah, I remember that. Everyone was wondering if we were heading back into lockdown. So what happened to oil prices? Did they completely tank?
Well, initially, yes. WTI crude, the benchmark we'll be using for this deep dive, dipped into the mid-$60 per barrel in early December. Not exactly a picture of holiday cheer, right? But then as we got closer to the holiday...
Okay, hold on, let me guess. The market realized Omicron wasn't as scary as initially thought, and prices started to rebound.
That's exactly what happened. It's fascinating how sentiment can shift so quickly in the oil market. As those Omicron fears eased, WTI started climbing. By the end of December, it had gained around 10% from its December lows. So in 2021, at least, we did see a pretty classic Santa rally play out in oil.
Okay, that is pretty impressive. It's a 10% gain in just a few weeks. But I'm wondering, did everyone anticipate that rebound? Or was it a surprise?
Well, I think a lot of analysts were caught off guard by the speed of the recovery. Remember, there were still a lot of unknowns about Omicron's impact on demand. But what's really interesting is why oil prices jumped so quickly.
Okay, get technical on me. I'm ready.
Well, part of it was likely what we call short covering. Basically, traders who had bet on oil prices falling were forced to buy back their positions as prices rose, pushing prices up even further. It's like a snowball effect.
So it wasn't just about easing Omicron fears. There were these trading dynamics amplifying the price moves, too. This is getting way more interesting than I thought.
It always is when you look under the hood. Right. Now, 2022 was a completely different animal. Remember, that was the year the Russia-Ukraine conflict really upended energy markets.
Right. Oil prices skyrocketed. So did any sort of Santa rally even happen in that environment? It feels almost impossible.
Well, it did, but in a much more muted way. Remember, oil prices were already elevated because of the war. So in early December 2022, WTI was fluctuating around $80 per barrel. Then by the middle of the month, it had dipped down to near $70.
Interesting. So even with the war going on, there were still these price swings happening. What drove that dip? Was it just traders taking profits after such a huge run-up in prices?
That was part of it, what's often called position squaring as the year ends. But there were also growing concerns about a global recession. Remember, central banks were hiking interest rates aggressively, and that was starting to weigh on economic growth forecasts.
Okay, so we had a mix of profit-taking and genuine worries about demand softening as the economy slowed. Makes sense.
Exactly. But here's the thing. Even with those recession fears looming, WTI managed to climb back up to around $80 by year end. So even in the midst of geopolitical turmoil and economic uncertainty, we saw this year end lift.
So even in 2022, with all that craziness, there was still this, I hesitate to use the word, but this Santa rally effect. Is that what we're seeing?
Well, it's certainly a pattern worth noting, and it raises the question, what could be driving this consistent year-end strength in oil prices, even across such dramatically different years? Now, let's put on our hypothetical hats for a moment and imagine what happened in 2023.
Okay, so 2023, this is where we put on our speculative goggles, right? Because we're looking back at it as if it's history, let's say, for our scenario. The global economy didn't completely melt down from those interest rate hikes. Things were,
cautiously optimistic.
Precisely. Imagine oil demand had found a stable groove. OPEC Plus was doing its balancing act with production, and global oil inventories were looking pretty normal, but there was one big question mark hanging over everything: China. Everyone was holding their breath to see how their demand would bounce back. after those COVID restrictions finally eased.
Right on the money. You also had this push and pull between recession fears in developed economies and robust demand from emerging markets. It was a real tug of war. So picture this. Going into December 2023, oil prices were kind of stuck in a range, let's say between $74 and $78 per barrel.
Okay, so a bit of a waiting game. Traders were watching for clues about where the economy was headed and what OPEC Plus might do next. Did anything shake things up as we got into mid-December?
Well, we might have seen a slight dip in WTI prices, maybe down to around $74 or $75 per barrel. Now, this could be due to a couple of things. One is what we call year-end position squaring.
I'm guessing that means traders are doing some housekeeping with their portfolios, right? Making adjustments before the year ends.
Exactly. They might be taking profits, closing out losing positions, basically getting their books in order. And on top of that, you might have some mixed economic data coming out, which could have added to the uncertainty.
So a little bit of pre-holiday jitters maybe. But what about the week leading up to Christmas, the core of this Santa rally period? Did anything interesting happen then?
That's where things could have gotten interesting. Remember, trading volumes tend to be thinner around the holidays, which can make prices more sensitive to even small shifts in sentiment.
Right. Fewer people at the party, so the music sounds louder. So what was the music in this case?
Well, let's say there was a slight uptick in overall risk appetite, maybe some positive economic news from China, or hints that OPEC Plus was considering further production cuts to support prices. Remember that final week of December can be a bit of a psychological game, too.
So even if the underlying fundamentals weren't drastically different, that year-end optimism, combined with thinner trading, could have nudged WTI prices back up, maybe towards that upper end of the recent range, around $78 to $80.
Exactly. And because we're talking about oil, those headlines about potential OPEC Plus cuts would have definitely played a role. Remember, those announcements can have a huge impact on market sentiment, even if the actual cuts don't happen for a while.
It's like everyone's trying to guess what OPEC Plus is thinking. And that uncertainty itself can move markets. But what about early January 2024? Did those hypothetical gains hold? Or did reality come crashing down after the holidays?
If we're following the patterns from 2021 and 2022, early January might have brought either a consolidation of those gains or a slight pullback as trading volumes pick back up, and the market refocused on those fundamentals we talked about.
Makes sense. So let's zoom out and look at the big picture across these three very different years. What are the key takeaways about oil and the Santa rally? Is it even fair to call it that?
That's the million-dollar question, isn't it? What's fascinating is that despite the wild ride oil prices took during those years, there's this consistent, albeit modest, year-end upward bias. It wasn't always a massive surge, but we saw support for prices as December came to a close, every single time.
Okay, that's a pattern we can't ignore, especially given how different those years were. But I'm still struggling with this idea of a Santa rally in oil. Doesn't feel quite right. It's like calling a hurricane a gentle breeze.
I hear you. And I think the key here is understanding that oil isn't driven solely by holiday cheer or year-end optimism. Remember, it's a global commodity with its own unique set of drivers. While those seasonal patterns can play a role, the real story is in the fundamentals: geopolitics, OPEC Plus decisions, economic indicators, and those ever-shifting demand forecasts.
So it's not really a Santa rally in the traditional sense. It's more like oil's own quirky version of a year-end phenomenon.
Yeah.
But it does make you wonder, what if there's something deeper going on here?
That's what I find so intriguing about this whole thing. We talk about the Santa rally in stocks as this psychological thing, right? Year-end optimism, the desire to close out portfolios on a high note. But could there be something more structural at play in oil markets specifically, something beyond just sentiment?
Okay, now you've really piqued my curiosity. Give me an example. What kind of structural factors could be contributing to this year-end price behavior in oil?
Well, consider how physical oil contracts work. Many long-term contracts for actual oil deliveries are negotiated and finalized towards the end of the year. This could naturally increase demand as companies rush to secure their supplies for the year ahead.
Ah, I see. So it's not just traders playing games with paper contracts. There are real-world supply and demand forces at work. That could be driving up prices in December.
Exactly. And there might be other factors we haven't even considered. Remember, oil markets are incredibly complex. There are nuances to refining capacity, seasonal patterns in consumption, weather events that can disrupt production or shipping. It's a whole web of interconnected factors.
Wow. So maybe this Santa rally in oil is more like a clue, a hint that something interesting is happening beneath the surface. It's a reminder that market patterns, even seemingly simple ones, can have deeper roots than we initially realize.
I completely agree. And that's what makes analyzing these markets so fascinating. There's always more to discover, more layers to peel back.
Well, I think you've given our listeners and me a lot to think about. The Santa rally in crude oil may not be as straightforward as its stock market counterpart, but it's certainly a phenomenon worth watching closely.
Absolutely. It underscores that even in a market as notoriously volatile and unpredictable as oil, there are underlying patterns and forces at work. And sometimes those patterns can offer us really valuable insights into how the market truly functions.
So for all you oil market enthusiasts out there, keep a close eye on those late December price moves. There might be more to those Santa Claus rallies than meets the eye. Who knows? Maybe there really is a hidden Santa working behind the scenes.
Perhaps. The oil market always has a few surprises up its sleeve.
And that wraps up our deep dive into the intriguing world of the Santa rally in crude oil.
Yeah.
We hope you found it insightful. As always, we encourage you to keep exploring, keep questioning, and keep that thirst for knowledge alive.
Until next time.